What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about Crocs, ticker symbol CROX, because this stock is actually trading at really low valuations. And it's also got pretty good growth at the moment. So I'm going to break this down. A lot of you guys in the Discord have been asking for an analysis on this company. So we are going to, again, go over the fundamentals, go over their more recent earnings calls, and then of course talk a little bit about the intrinsic values and the technical analysis on this company as well. So hope you guys enjoyed this video, find it helpful. If you do, please make sure that you drop a like and don't forget to subscribe to the channel. I would really appreciate it, and links to our Discord and Patreon is going to be down in the description and in the pinned comment as well. You do get access to a lot of members only private videos, so you can unlock a lot of those tutorials and lectures on fundamental technical analysis, including options trading as well, and of course a lot of Excel spreadsheets, retirement calculators, debt calculators, intrinsic values, S&P 500 valuations, volatility spreadsheets, and of course access to over 20 plus Discord channels, including trade alerts, trade ideas, options, discussion channels. Everything's going to be included. So link's going to be down below. We'd love to have you on board. So let's talk about Crocs. And I have honestly never owned a pair of Crocs, believe it or not, but I've never owned a pair of those those most popular sandals. I have never, but I do plan on buying one to see what the hype is all about. But revenues here, a little bit over $1 billion in the third quarter, up 6% on a year-over-year basis. Gross margins expanding 70 basis points. Adjusted gross margins up 230 basis points, sitting at just over 57%. And SG&A as a percentage of revenue, so selling, general, and administrative expenses, was 29%. So the operating margins ends up being over 26.2%, and diluted earnings per share was up 6% to just under $2.88 per share for the company. This right here is the overall revenues, and of course for the first 9 months, you'll notice that the company still experienced some decent growth. Revenues came in at just over $3 billion versus same time last year of 2.6. So if you do 3 divided by 2.6, we are looking at a growth of 15%, which again, quite reasonable growth. It's not like nothing. 15% is decent. And gross profit was up to 1.68 billion. So let's just do 1.68 divided by 1.36. And we are looking at a 23.5% growth on the gross profit basis. And net income was up to $539 million. So 539 divided by 402, we're looking at a 34% growth. So if revenue grows 15%, gross profits up 20+%, and the net income's up over 30+%, that's actually a very good sign of good operating leverage, because operating margins expanded, net margins expanded, because even though revenue growth was not as strong, net income growth was actually pretty good. And as a result, they do have operating income here, income before income and taxes, $702 million, right? That's up from $542 million. So if you do the math there, 702 divided by 542, we're looking at almost a 30% growth rate here on an operating basis. And diluted earnings per share coming in at $865. That's up from $651 in the first 9 months for the company. And shares outstanding have slightly gone up on a diluted basis from same time last year as well. So this is the overall sort of a business. And Crocs for the longest time was very stable and non-growing business. If you take a look at the revenues, they were pretty flat, right? Pretty flat up until a couple of years ago. You'll notice the last 3 years have been absolutely phenomenal for Crocs. I mean, whatever they're doing in terms of marketing has been working, because they've gone from 1.3 billion to 2.3 to 3.5 and now almost hitting $4 billion in revenue. And same thing has happened with gross profit as well. So we've gone from 750 million to 1.4, so more than doubled in 2021, then 1.86 billion, and then now $2.1 billion. Same thing with operating income, right? Last 3 years have been phenomenal for the company. This right here is net income. So going from 120 million to well over $540 million for the company, and diluted share count has also gone down over the years from 90 million down to now sitting at 62 million shares. So we've got a business that in the last 3 years has seen and experienced a lot of growth in the right direction. Both profitability and margins have also expanded. It's doing a lot of share buybacks, and the margins and efficiency has been very good. So you've got 53.5% gross profit margins, net margins at over 17%, levered free cash flow margins at 17.8%, and very good efficiency in terms of return on common equity, capital, and assets as well. And more importantly, if you take a look at net income per employee, all the way at the bottom, $101,000. That's up from $71,000 on a 5-year basis. So once again, what does that tell us? That tells us the company is generating more net income on a per employee basis. So their employees are becoming more efficient. They're becoming more motivated, right? So that's actually a very, very good thing for Crocs. I got blanked out a little bit. So that's actually good, right, from an efficiency standpoint. Now, going over to the balance sheet, we've got cash and cash equivalents sitting at about $127.3 million. That's actually lower from same time last year. And then if we come take a look at goodwill, that's about $711 million. Intangible assets, we're looking at $1.8 billion. So when you combine those two numbers, $2.4, $2.5 billion, over 50% of the assets are sitting in goodwill and intangible assets for the company as well. And we don't have a lot of cash and cash equivalents or marketable securities or investments. So that is a little bit of a concern and a drawback for Crocs. But inventories, if you take a look, also sitting at $390 million. So if you do the math here, 390 divided by 4,581, we're looking at 8.5%. This is less than 10% of their less than 10% inventories on their assets. It's quite okay, but we don't want to see this number increasing, which would simply mean that inventory is not selling, like the product is not selling through. So 8.5% is quite reasonable. Now the company does have long-term borrowings of about $1.9 billion and total liabilities of $3.3 billion. And current liabilities of sitting at $647 million. We got current assets at $979 million. But then if you take inventory out, we're looking at about $600 million in current assets versus $647 million in current liabilities. So the balance sheet for Crocs is straight up not good. We've got a quick ratio that's under 1. Current ratio is a little bit over 1 because we account for inventory in current ratio and we don't account for inventory in quick ratios. And then when you take a look at cash to debt, really not the best situation because the company has little to no cash with about almost $2 billion worth of debt. Of course, total assets are over total liabilities, but over 50% of total assets also are coming from goodwill and intangibles. So the balance sheet is a little bit of a concern for Crocs at the moment. Now, in terms of growth, this right here is the forecast from $11.68 all the way up to $17.72. That's going to be the forecasted growth here for Crocs. And then if you take a look at the valuation, this is really low. I mean, we're looking at under 7-8 times earnings multiple with a price to sales a little bit over 1 and price to cash flow at just under 6. So this is really low in terms of the valuation. This is the guidance from the company. They're expecting revenues of about 4 to 4.06 billion with an adjusted EPS of 11.83 to 12.22 for the company as well. So if you plug in some of these numbers for our own model here, so we're going to plug in Crocs here. Let's just assign, 4 times 0.17. We're looking at 680. Let's just do, what was the net income for the first 9 months? Let's go back here a little bit. We are looking at a net income of about $539 million. So let's just do 700 million just to start with for net income. That will give us an EPS of about $14. I think that's going to be for next year though. So next year, $14. Let's just come back to this forecast. And next year, analysts are expecting $12.13. So we're going to have to lower the estimate here to $6.50. And now we're sitting at about $13. I think that would be quite reasonable. Okay, so $650 million in net income for this year, which I think might be a little bit on the lower end because they've already done $580 something million, right? So they've already accomplished $539 million. So 650 minus 539 is going to be like less than $100 million, which I don't think they're going to do. I think they're going to do a lot more. So why don't we assume for 700 million just to start? And then the growth rate is expected to be a lot lower for the company, right? So we're going to have to do 12%. Or maybe even lower, because if you take a look at the analyst expectations, they're only expecting 11% growth from Crocs moving forward. So let's just plug in 10% here. Price earnings multiple, we're going to have to go lower, a lot lower. Let's just do 12 here. 12% discount rate, 10% margin of safety, and minus 1% in a share dilution, or let's just do 0.5% because they have been buying back a lot of shares. We're looking at $117 in actual intrinsic value for the business. I think the reason for this is because of the multiple that Crocs is trading at. If you go down to, let's say, 8 times multiple, that's when it comes down to $78, right? So a lot of that is coming off of the P multiple, the valuation, right? Because it's trading at such a low valuation. If you take a look right now, it's trading at 6.5, almost 7 times earnings. That's why Crocs, if we assume for, let's say, 8 or 10 times price earnings multiple, like look what happens if I change this to 10, it's considered to be undervalued by 22%. So there needs to be both a growth rate assigned and multiple expansion for Crocs to actually make sense at these levels. So if you look at the guidance themselves, 1183 to 1222. So if you take that mid guidance of $12 in earnings per share, or actually current guidance is lowered, so it's 1155 to 1185. So we're looking at, let's say, 1165, just to be on the safe side. And the price right now is $80. So 80 divided by 1165, under 7 times earnings multiple, right? So it's actually a really, really, really cheap stock from a multiple basis. But again, the growth rate needs to be decent. If it's anything over 10% growth, then the P multiple can be 8 to 10 times, right? So if you come over to our sensitivity grid, if it's 8 to 10 times P multiple with a 10% growth, then of course the intrinsic value is sitting somewhere between $78 and $97 per share. The only concern I would have with Crocs is the balance sheet, right? Balance sheet would be my only concern, considering that, a lot of intangibles, a lot of goodwill, inventory levels at 8.5%, which is okay, but the company does also have a lot of debt relative to the cash. This right here, since July of 22, it rallied over 200%. There's a lot of multiple expansion here, but this is the overall technical analysis where it's right now trading in a little bit of a lower high and a higher low pattern, so a bit of a symmetrical triangle. And I would love at $42 for Crocs. This right here would be just like an amazing price point for the company. But like I said, my only concern would be the balance sheet at the moment. So that's something to keep in mind for this stock. Hope you guys enjoyed this video. Let me know your thoughts down in the comment section below, and what do you think? The multiple is actually quite low for this business, for the business that is actually growing in revenues and earnings right now. So that's something to keep in mind. Hope you guys enjoyed it, found it helpful. Let me know your thoughts down in the comment section below. What is the appropriate P multiple and the price to price growth rate for Crocs that you believe should be assigned? But my intrinsic value based on 6 to 10, somewhere between 6 and 10, price earnings multiple and a 10% growth rate sits somewhere between $58 and $97. I know it's a pretty wide range, but that's only because of that multiple from 6 to 10 is quite substantial. It's over 100%, right? Different. But I would $42 is what I would be looking at technical support wise. And at that price point, I would consider the stock to be undervalued from even the most conservative estimates, right? Even if you go 8% growth rate and a 6 times P multiple, even if you go 6% growth and 6 times P multiple, right? Then it would be undervalued even at that price point at 42. So that's where we are. Let me know in the comment section down below. What do you think about Crocs? As always, make sure that you drop a like, subscribe to the channel, join our Discord, join our Patreon, members only private videos, Excel spreadsheets, Discord access, everything's going to be included. And as always, happy investing, and I will see you all in the next video.